basis points worth of hikes, the fastest tightening delivered in about 4 decades. Of course, there was an energy shock, a terrible war in Ukraine that prompted some of those inflationary pressures. And of course, we had to see central banks reacting. And it wasn't just the Fed. We saw it with central banks all over the world. They all had to start tightening. And I thought it was really interesting that in the space of months, we unwound a decade of essentially what was zero interest rate policy, negative interest rate policy. For a long time, market participants were thinking, we're stuck in this negative zero interest rate environment. How are we going to get out of it? And in the course of a couple of months, we did actually manage to get out of it. So 2022 was a really exciting one for the central banking community. And I think today's panel, we're going to explore where it goes from here. How are central banks doing with this fight against inflation? Are we close to the peak in interest rates? Is there a sea change coming in terms of how we think about central banks' mandates? Hopefully, we will answer a lot of these questions and more throughout the course of the panel. But first, let me introduce our panelists. So let me just start off with Kjerstin Braathen, right at the left there, who is the Chief Executive Officer of DNB in Norway. To her right, we have Larry Summers, Charles W. Eliot University professor, Harvard Kennedy School of Government, USA, former Treasury Secretary, of course. To his right, we have Thomas Jordan, the chairman of the governing board of the Swiss National Bank. And then to his right, we have Julio Velarde, the governor of the Central Bank of Peru. Very well represented. I also think I spotted the Bank of Japan governor here as well. So thank you very much for attending our session. There's a lot of focus on your perspectives as well this week. Governor Jordan, I'd like to start with you. A central bank friend of mine once said to me that you don't become a central banker to win a popularity contest, especially not when you're tightening interest rates. And I think 2022 was a year where, at best, central banks came under a lot of scrutiny. At worst, they came under a lot of criticism because they had to tighten so rapidly. And these were the same people who in 2021 had told us that inflation was transitory and that we didn't need to worry about it. Do you think perhaps things could have turned out differently if the central banking community had reacted quicker to the first signs of inflation?
Well, I believe this is a fair question. So we probably all underestimated the inflationary pressure in 2021. So it was not only the war, it was already a very expansionary monetary policy, combined with a very expansionary fiscal policy and a negative output shock, and that put inflation up a lot. So I think it really a little bit demonstrated that the conventional wisdom is still valid. So price stability is very important. Expansionary monetary policy can create inflation, and we have to be very careful. And probably, with the benefit of hindsight, monetary policy was all over the place a little bit too expansionary.
Do you think that there was an element of recency bias just because for so many years it didn't seem like there was going to be strong inflationary pressure? For years we've been talking about low inflation, disinflation, and I'm definitely going to ask Professor Summers about this shortly. But then when inflation did show up, it showed up very aggressively, very uninvited. And for a while people just thought, well, you know, inflation can't be this new structural phenomenon that's going to stay with us and be persistent. High levels of inflation.
Yeah, well, it really showed that low inflation is much better than high inflation. So we discussed many times whether inflation below 2% is really dramatic, what we should do. But now we see inflation rates between 0 and 2% as long as the output gap is closed. In a way, it's not too negative. Now we have a big problem. Inflation is far too high. It's negative not only for the functioning of the economy, but also it's very negative, especially for low-income classes. The population doesn't like inflation. So I guess the focus on price stability for central banks is absolutely essential. And we have to have this commitment. We have this mandate. And I think all central banks have then to deliver and bring inflation back to price stability.
Larry, can I ask you just sort of a mark-to-market on your secular stagnation thesis? Because back in 2013, you described the US economy as being in a state of secular stagnation, low demand, low inflation, diminishing returns to monetary policy, which of course, back then, rates were very, very low. And you didn't see a strong inflationary impulse emerging. Would you characterize as being right now in a new inflation paradigm?
I'm not sure. I would put it this way. In 2013, I saw secular stagnation manifest in a chronic excess of savings over investment that found its way into low interest rates, sluggish growth, savings flowing into existing assets, leading to elevated asset values and high multiples. And those seem to me to define an era. And nothing that has happened since has changed my mind about the view that that defined the era from 2013 until the beginning of the pandemic. I saw that gap. I wouldn't have known precisely how to quantify it, but the potential gap between savings and investment that was leading to the low interest rates and that was leading to the sluggish growth was perhaps 4% of GDP. That's a very imprecise number. We had the pandemic, and we then had, for 2 years in a row, 14% of GDP in fiscal stimulus. We had fiscal stimulus more than half as large as the United States had had during the Second World War. We had fiscal stimulus that measured relative to the GDP gap was 5 or 6 times as large as we had had in response to the financial crisis. And so with that magnitude of fiscal stimulus, you were far more than closing the secular stagnation gap. And that's why I, in early 2021, was very confident that we were setting off a serious inflation problem, because I saw that the secret sauce of economics is arithmetic, and that we were closing far more than the gap. And it was justified by all kinds of motivated reasoning, including the recency bias that you describe. I think matters are much less clear right now. On one hand, the demography that was a central driver of secular stagnation is still where it was, or if anything, a stronger force. The decapitalization associated with the rise of intangibles, associated with the fact that my $500 phone has computing power comparable to what a $40 million computer did a generation ago. That is also still there and operates for secular stagnation. On the other hand, and I'll finish up quickly, we have a strong movement towards much larger levels of government borrowing, both accumulated debt to GDP and subsequent flows of borrowing. And we have major drivers to investment associated with the green transition, associated with the movements to resilience. And we have a set of cost increasing pressures pointing towards more inflation. My best guess is we're not going back to the interest rate era that characterized secular stagnation, where the zero lower bound was a central problem for central banks. That's my best guess. But whereas I was confident about secular stagnation, and then I was confident about inflation, I don't see a basis for high confidence about the nature of the next era having revealed itself yet. That's why I think in general, central banks need to focus on gauging and doing the right thing at each moment. And they put their credibility at risk if they engage in excessive forecasting of their future behavior.
Fair. I always wondered to myself what central bankers discuss when they're alone together. And I got a little glimpse of it now in the speaker's room. And 2 governors here were discussing, so what's your level of inflation? Oh, well, my level of inflation is in this. What is your view of R star? So those conversations actually do happen among central bankers. But I do want to ask you also, just to follow up to what you were saying about whether you think your estimate of R star, that neutral rate that central bankers talk about, whether you think that has also structurally shifted higher, and whether or not you think this signature piece of legislation that everyone seems to be talking about here in Davos, the Inflation Reduction Act, can do anything to help structurally lift our star higher in the US?
Our star thought of as in real terms depends upon the balance of the factors, demography, decapitalization versus debt and stimulated investment that I described before. And no question that the Inflation Reduction Act is pushing towards more green transition and more investment. On balance, I think our star is more likely to rise than fall from the 0.5% level that people were talking about earlier. But that's not, as I say, that's not a high confidence view. And I think it's also possible, and this is much less in the discussion, that in addition to whatever's happening to our star, we may be seeing some reduction in the sensitivity of economic activity to interest rates. If you look at the fraction of durable goods spending in the economy, particularly longer-term durable goods spending, it has come way down. Less residential investment, people buying iPhones rather than foundries, and those things will tend to operate to make spending less sensitive to interest rates as well, and that creates the possibility of more volatility in real interest rates and raises the question of whether fiscal policy should be used more actively in stabilization policy.
Kjerstin, I'd like to come to you now. I think it would be almost impossible for me to find a CEO of a European bank who wouldn't express their joy at moving away finally from -0 interest rates. Obviously a good thing for the banking sector. But I do want to ask your perspective on just how quickly central banks tightened last year, whether you were caught by surprise, because obviously you have to make business decisions based on financial conditions, and all of that is a corollary of what central banks are doing. So number one, were you caught by surprise? And then also, do you think, given the communication that central banks were delivering in 2021 and then the actions they took in 2022, was there an element of credibility, perhaps, that was put to the test?
Well, first of all, I lead a bank in Norway, and Norway has, just for a very brief period, been at 0 interest rates. And coming into the pandemic, we actually had a reference rate of 150 basis points. So it's a little bit different than comparing to the Eurozone. And the Norwegian Central Bank has actually been quite clear of having no desire to move into negative interest rate. And they started hiking in September 21. So them, along the New Zealand Central Bank, were the most rapid to start hiking again. That being said, it's also been the case for the Norwegian Central Bank that they have had to up their estimates. And the most substantial hikes have come during the autumn of 22, where they have hiked on every central bank meeting in the autumn. Has it come as a surprise? I think yes, to everyone. I think nobody have been able to predict what we've been seeing. It's clearer now in hindsight, always easier to see. But I think we are, I think central bank policy also differs compared to the structures of the market, and we are a floating rate economy. So it very quickly floats through into the market. I think this is one of the different characteristics now, also compared to previous economics eras where we have seen the same type of movement, that more economies, at least in Europe, have floating rate structures. It's good for the efficiency of monetary policy as long as it's not a degree of vulnerability that leads to that really tripping the consumers and leading to other kind of undesired effects. I think in isolation, there is a lot of positive things about not having negative interest rates. But of course, for banks, we live in coexistence with the economic environment. Increasing interest rates is positive only if it doesn't kill growth long term. I think short term, that's not the issue at the moment. And of course, if it doesn't lead to instability and losses, that has a magnitude that surpasses the increase in interest rates.
Governor Velarde, I'd like to move on to you. I'm interested in hearing your perspective on inflation, but before that, I'd just like to ask you, because we're all watching some of the political demonstrations that are going on back home, how do you think about monetary and price stability in the context of political instability? How does that influence your decision making?
Well, we have been used to political instability. We have had an average inflation of a little more than 2% in this century. Of course, in a particular period, a particular month, it might affect somewhat the price of food, but I believe it's not the main factor behind inflation.
So the old adage is when the US sneezes, the rest of the world catches a cold. I think it also applies in a similar fashion to the Fed. And when the Fed start hiking interest rates, the rest of the world will inevitably follow, particularly emerging market central banks as well. We saw a massive appreciation in the US dollar that put some pressure on emerging market currencies. To what extent are you leaning over your shoulder and watching what the central bank, what the Fed chair is doing every meeting?
I see one important country in Latin America that follows closely the Fed. They even changed the date of their meetings to be just after the Fed meetings.
Right.
But most of the other countries actually not follow. While we have been similar phenomena that affects the whole world. Of course, American expansionary monetary and fiscal policy had to do with inflation. But it was a shock that was being suffered by all the world. So it's not surprising that everybody started hiking. And in Latin America, Brazil was the first country to start hiking at the end of the first quarter. And then all the others started in the second half of 2021. In case we started in August. We started from 0.25, that was our rate. And before that, on COVID, also every central bank lowered the interest rate because they were facing the same phenomena. It was not because the Fed decreased their interest rate. No? I am not saying that it doesn't affect us. In the 10-year bond, you can see that the 10-year bonds of almost any country are affected what is happening to the 10-year bond in the States. But in the overnight rates, I don't see that clear influence, except when we are facing the same phenomena where the reaction of the central banks will be more or less the same. No?
So sometimes people say this to you that central banks, global central banks are coordinating together.
If you face the same phenomena, you will react more or less of the same way. No?
Okay.
But I don't see it. And actually, Latin America and Eastern Europe were the first to react to the increase. At first, just to normalize the policy. That is, we didn't need such an expansionary monetary policy when things started to settle again. And then, of course, to fight inflation.
Governor Jordan, how do you think we're doing in the fight against inflation? I've been having a lot of conversations here on the sidelines of Davos, and I think the consensus view is that, broadly speaking, I'm not speaking specifically about Switzerland, that inflation seems to have peaked. And the perception is we are going to see headline rates dropping quite quickly, namely on back of base effects. But that getting to 4% is going to be easy, but getting from 4 to 2 is where it gets a little hairy. How would you characterize where we are in this fight?
Well, I think this is, in my view, absolutely correct. We will see now headline inflation coming down quickly because of energy prices are coming down. We have these base effects. But core inflation is not coming down as quickly as that. So it will be much more difficult to bring inflation from 4% to 2%. So the commitment of central banks to go back to price stability will be absolutely essential. We will see whether this comes with a recession or not with a recession. This is difficult to predict.
Does it matter for central banks, though, that if you do have to keep going and keeping rates restrictive in order to get inflation from 4% to 2%, that it might tip an economy into recession? Do you think about that trade-off?
Well, the absolute priority should be bringing inflation back into the range of price stability. So this is absolutely key for the credibility to fulfill the mandate. Hopefully it comes with only a little bit limited impact on the real economy, but this is very difficult to predict. Of course, when we will see a weakening of the economy, under normal circumstances, that should help to bring inflation down. But we should not underestimate already the second-round effects that are underway. And there, what we see everywhere, also in Switzerland, there's a little bit a change in the way firms are dealing with price increases. So they do not hesitate anymore to increase their sales prices. So that is different from maybe 2 or 3 years ago. And that is also, I think, a signal that it is not that easy then to bring inflation really back to 2%. We also see a change in probably the behavior regarding wages. And we often speak about inflation expectations. Everything is well anchored, so it's not a problem. But if you look at wage formation, so this is very much backward looking. Even at the Swiss National Bank, where we have all the economists, and wage formation is basically we take inflation from last year, and this is the basis for making a decision regarding future salaries. And we are no exception. I think this is everywhere the case. So, kind of fairness argument regarding salaries. So once inflation is high, the pressure coming from wages is here, and this is probably also the proof that it will be not that easy really to bring everywhere inflation down quickly.
Very clear. Larry, do you think it's time for central banks' mandates perhaps to be reconsidered, that 2% more or less price stability target that many central banks around the world have?
I think it would be a grave error for central banks to revise their 2% inflation targets upwards at this point. I say that as someone who was negative on the idea that the United States should put in place a specific numerical target. It seems to me, though, that having failed to attain the 2% inflation target, having re-emphasized repeatedly the absolute commitment to the 2% inflation target, to then abandon the 2% inflation target would do very substantial damage to credibility. If you can adjust once, you can adjust again. I think much of the rhetoric surrounding it's not worth having a recession to reduce inflation, which is an argument that is often heard, misunderstands the counterfactual. The counterfactual is not, can we have more inflation and not have a recession? The counterfactual is, if we fail to deal with inflation, we are likely to have a larger and more serious recession at some subsequent point. And so even if the only thing one cared about was maximizing the average level of employment over the next decade, and did not care per se about the rate of inflation, I would argue that maintaining a commitment to price stability as it had been defined would be appropriate. In fact, there has been a kind of adjustment of the target. We used to think of the 2% inflation target as a kind of average inflation over time. No one anywhere is suggesting that because we had 7% inflation for 2 years, we should have inflation well below 2% in order to get to the average. I think that's appropriate, and I would not argue for anything else.
The Fed at one point did indicate they might go down that route with average inflation.
But it was all on the high side. It was never on the. It was never on the low side of swinging below 2. So I think we have already used a certain amount of flexibility that was present, and I think that was the appropriate thing for us to do. the single most important thing that I think a student learns in a macroeconomics course is the distinction between nominal and real. That by fiddling around with money and stuff, you can affect what the price level is, you can affect the rate of inflation. But ultimately, what happens in the real economy is not determined by monetary policy, and you can't make it happen better by hitting some kind of monetary policy accelerator permanently. And I think it's very important that we keep that message in mind. There are things we should be doing. There's all kinds of things with respect to social relief within particular countries, with respect to promoting necessary public investment that employs the unskilled. I think the world is falling far short of what it should be doing to cushion blows and to cushion necessary adjustments with respect to the developing world. But I think to suppose that some kind of relenting on an inflation target will be a salvation would be a costly error that would ultimately have adverse effects, as it did in a spectacular way during the 1970s for real economies and working people everywhere.
Very clear. Just a quick one before I move on to Kjerstin. Do you have a view on where the Fed are going to end up in this cycle, where the terminal rate is going to be? I've got to ask.
I like as an academic operating at the level of these high principles rather than your journalistic questions about particular rates. I would just say I look at the path of rates, both short and long, in markets. And whereas the path that existed a year ago seemed to me extremely implausible, it was hard for me to imagine that that would materialize, and it hasn't. I can't imagine this path materializing. But I can see many, many more scenarios in which rates end up higher than what is currently priced. Then I can see scenarios where rates end up lower than what is currently priced. Therefore, I'm a bit surprised by the market's forecast of what's going to happen. And if you regard that as being a slightly evasive answer to your question,
I quite
that
like
was
it.
wholly intentional.
We can read the tea leaves, though. Kjerstin, I want to move on to a slightly different tack, but it's also in parallel to what Mr. Summers was just saying now. And just the coordination between fiscal and monetary policy. In the UK, we got into a bit of a pickle earlier this year because the central bank had started tightening, and at the same time, the government came out with a very expansionary fiscal budget, a lot of it via unfunded tax cuts, and the markets didn't like that. And we saw this big reaction in the gilt market because there was some concern about the state of public finances, and also the fact that monetary policy and fiscal policy seem to be working cross purposes. How do you think about central bank tightening in the context of this fiscal expansion environment that we're in right now in Europe?
Well, I think that the UK was the extreme example of the dilemma that you're seeing across many countries, deploying fiscal policy to try to support more the vulnerable parts of the population or sectors, versus monetary policy is going in the opposite direction and trying to tighten. And I think the dilemma is the more you support and the less targeted you are in the support, the more monetary policy will have to tighten in order to get inflation to where we want it to be. I think, sitting a little bit on the side, that it's important to appreciate the challenge, and especially for politicians who have been elected and depend of the trust of their voters. But I must say that I'm glad to hear the very firm voice that I at least feel that we're hearing from central bankers and those who are supporting what the central bankers need to do, because there is no way around reaching some form of stability. I think it's much harder to say what the level should be or what the consequences would be, but having a level of price stability and continued credibility in central banks, I think those are the two key factors. If I were to look from our economy and the businesses we work with, in order for them to actually move on and invest in further growth. And unfortunately, I agree with Mr. Summers in seeing all of the factors that are pushing us in the direction of higher inflation. And I think we will have to continue to expect that there will be fiscal policy, and maybe to some extent fiscal policies are also the most effective to stimulate growth in the way we are looking for it to do, stimulating the supply side economy, stimulating competition, stimulating innovation. These things can happen without necessarily hurting inflation. But if we are not in an economy with stable prices, I think none of us have, well, very few of us have lived in economies where this has been the case. In a way, it makes it even more difficult for politicians, because most people today, they aren't used of the fact that money is actually costing something. But it doesn't take away the fact that if we're not able to get into an environment of stability, that is the most hurtful thing over time.
Governor Velarde, can I put that question to you as well? To what extent, I know that there has been a very strong period of fiscal adjustment in Peru, perhaps unwillingly, because there's been so much political turnover that it's been quite difficult for the government to push through any serious spending. Has that complicated your job?
No. Now, first, it was an increase in taxes because of an increase in commodity prices. And of course, part of the expenditure came down because expenditure related to COVID transfers, etc., was lower. We had a fiscal deficit of 8.9 in 2020 and 1.6 last year. But it has not been an adjustment of fiscal policy. It has been mostly a recovery of taxes, the adjustment of expenditure. Capital expenditure has been increasing a lot in these 2 years. No? That was your question or something else?
Well, it's just more how the fiscal backdrop has some sort of an influence, if at all, on your decision-making.
Of course, if we had a very terrible fiscal situation, it will be very difficult to have a monetary policy with a low inflation. As was mentioned by the previous speaker, the case of England was particularly visible. But we are forbidden to lend to the government directly. That is one of the few costs that can lead to my removal, is giving money to the government. Yeah. And we are completely autonomous. And when I say completely autonomous, I have never been called by the president. If the Minister of Finance called me, because I am polite, I will go maybe, but I am not forced to go, etc. No? It's very different. Remember, Stefan Index was saying that he had never met officially the Minister of Finance. Of course, they had met informally, but sometimes you tend to overestimate the fiscal and monetary coordination. Of course, the ideal is for both to go in the same way, but they are not always coordinated as many times it assumed. No?
Very clear. Central banking independence then is still very much there. Governor Jordan, I'm getting towards the end of this session, but I do want to ask you, this era of negative interest rates, are we ever going to go back to it?
Well, this is, I think, an interesting point for us. It was absolutely essential to have this instrument of negative interest rates. We are happy that we are out, that we are now in a positive territory. It's much, much better. But we can use this instrument in case it's necessary. So when we are really going back into negative inflation, we will not hesitate to use it again. Of course, it's much better not to use it. But it's also a proof that we can maintain a low inflation goal, price stability, and still having instruments in order to achieve price stability. The instrument of negative interest is an important element, an important instrument. But of course, it's much better today when we are back in positive territory. There are certain distortions, especially in the banking system, where it's better not to have negative interest rates. But all in all, in Switzerland, the banking system survived this long period of almost 8 years of negative interest rate, much better than expected.
One thing I do want to ask you about is the size of the balance sheet, because SNB does have the largest balance sheet as a percentage of GDP out of all of the central banks in the world, including Bank of Japan, too. There has been some criticism directed at the SNB because some of the investments have gone into the likes of US equities, tech stocks, and the amplified losses for the year. And that number came out in December, quite a big number. Do you think it is time to think about, first of all, unwinding the size of that balance sheet and perhaps reconsidering where that money is being invested?
Well, our balance sheet is the result of our monetary policy, what was quite successful over the last couple of years. So we had to expand our balance sheet because the exchange rate was too strong in real terms, not only in nominal, also in real, and the interventions were extremely important. Now we are a little bit in a different situation, and we are also able to sell some of our foreign exchange reserves again. But we have to see the loss that we are having last year has to be set in the context of the gains that we made also over the last couple of years. And it's obvious when interest rates are going up, the stock market is coming down, and the exchange rate is appreciating, then with this kind of balance sheet, we are making losses. But that will probably also change again in the future. We have no proof that the composition of the balance sheet was not sensible. And on the contrary, without moving into stocks, probably the overall losses would be even bigger. So I think the composition of our balance sheet made a lot of sense, and we will continue with this kind of investment strategy.
Thank you. I'm actually going to just jump to a slide now. I have a slide given to me by the World Economic Forum, and this is one that was put together from their Chief Economist Outlook report. And at the end of this panel, we're going to put up a QR code that you can scan to get access to the full report. But the question that was posed is, a year from now, what is your expectation for monetary policy in the following geographies? And you can see, in the case of the US, for example, 55% of economists think rates will be tighter, 27% looser, Europe 59% tighter, 27% looser. I'm just going to do a quick roll call. If we can go around the panel, I'm going to ask you the exact same question. Do you think interest rates where you are going to be tighter, the same, or looser? If you don't want to respond, that's fine. And then we'll open it up to Q&A.
Do we start?
Yeah.
Well, for the States and Europe higher. For Latin America, lower. We increased 18 times the interest rate already. Yeah. And many countries they have said they have reached their peak, or almost at their peak. No?
Thank you.
I also believe that, I think especially in the US and Europe, everything that we see is inflation is still at the level that tighter monetary policy is necessary.
Marginally tighter, perhaps. I want to, just since I've got a chance to talk, I want to say one other thing. I have no views about the Swiss Central Bank and its context of handling its balance sheet. I do think that it is noteworthy that after the crisis had passed, after we had had the terrible illiquidity associated with COVID, the United States, in the name of QE, on behalf of taxpayers, through the central bank, termed in our national debt on a very substantial scale by issuing, in effect, floating rate bank reserves and purchasing long-term bonds. It did so at a moment when roughly every corporate treasurer in the world was terming out its debt to move to the longer term. I saw an estimate that the mark-to-market loss associated with post-crisis QE had been on the order of $800 billion. That is a lot of money. And I do think that we need, in addition to thinking about the stimulative and contractionary aspects of QE to focus on the balance sheet, debt maturity aspects of QE. And in retrospect, I think that was a highly problematic set of steps that we were taking in the United States.
Hopefully in our next panel, we can talk more about that. Kjerstin, quick question to you, and then we'll hopefully get some Q&A from the audience as well.
Well, it would be very fun to disagree with this very esteemed panel who obviously knows a lot about this, but I can't say that I do. So I would, talking about Europe and the US, I would think tighter.
Tighter. Okay. I think we're pretty unanimous. Like any good central bank monetary policy meeting, unanimous decision. Okay. If we have any questions from the audience, now would be the time. Yes, sir.
Yes, thank you, everyone. With the microphone, it's a little bit better. Thank you, everyone. My name is Martin Schwab. I'm a part of the Global Shapers community from the Bern Hub. And next to them, I'm also a politician here in Switzerland. I have a question to you, Mr. Jordan. I know a lot of people, they are eating their bread without butter. They look where they can economize as much as possible because they are such in a dire situation. And also among us, the young people, we are very critical about the future. Can you give us a little bit hope? Will the future be better than it is today?
Well, I'm always an optimist, especially for Switzerland. And with price stability, that should contribute, I think, to a good future as well. But you are completely right. I think policies should ensure that the life of people will be better in the future. And it's not only ordinary fiscal policy, and that was mentioned before by Larry. I think it's also structural policy. So when structural policy is right, firms will be competitive, and we have growth, and we have real salaries increasing. I think these structural policies in Switzerland, but globally, are extremely important. And I hope that in Switzerland, politicians are reasonable to recognize the relevance of these structural issues.
Any other questions? Oh, one over there.
There you go.
Oh, that's
Here.
there.
Hello all. I live in Davos. I'm a guest today. You talked about a lot about economic growth and inflation. What other potential dangerous consequences are waiting behind the corner now that we have reached the end of the zero or almost negative interest period of interest rates? I'm thinking about pension funds, debt, or emerging markets. What's the question clear? So now we have reached the end of the period with negative or zero interest rates. What other potential dangerous consequences are waiting behind the corner regarding debt, regarding pension fund, regarding emerging markets?
Maybe one way to phrase that is, and we haven't touched a lot on this in the panel, is interest rates have been rising in an era of very high debt overload. There's been a huge increase in private public debt over the last couple of decades. How does that contextualize where we are with higher interest rates?
Well, I believe it's a problem. The high level of debt diminishes resilience of economies, households, etc. So I think to have a reasonable level of debt, public debt, but also household debt, is absolutely essential. And we see now when governments are not bound by having too much debt, they can react to certain shocks. If their fiscal situation is really bad, if the level of debt is already high, the room of maneuver is limited. And of course, they get much more vulnerable in case interest rates are increasing. So having sound fiscal policy over the cycle, having a limited amount of debt, having something with a debt break as we have in Switzerland, I think this is something that is in the medium to long term very beneficial for economists.
Larry, do you want to jump in? We've got about 30 seconds, but would love to hear your views on this as well.
Much depends on R star. If R star ends up high, these debt levels are going to be quite problematic. If R star ends up low, they will be less problematic than many people suppose. Probably the debt problem about which I am most concerned is the developing country debt problem, where I think the combination of increases in interest rates, a stronger dollar, what's happened to oil prices, possible global recession, the continuing burdens of the pandemic and of climate change have created, I think, a near perfect storm for many of the poorest countries in the world. And I think finding comprehensive approaches to their support, critically including dealing with debt, is probably the most important of the debt challenges that I would see ahead.
Absolutely, and I think that is a great place to leave it. Panelists, thank you so much for joining me today. Really enjoyable and informative panel, and thank you to everyone who attended this session.